Here are two things that are both true at the same time, and the gap between them is the most interesting story in personal finance right now. Fact 1. The average American car buyer in 2026 is $7,183 underwater on their vehicle, meaning they owe more on their loan than their car is worth. Nearly 44% of them are signing 84-month loans. That's 7 years, because that's the only way the payment fits. And repossessions hit their highest rate since the Great Recession last year. Fact 2. At the same moment, a business owner in the same country can walk into a dealership, buy a $120,000 Cadillac Escalade, and deduct the entire purchase price, all $120,000 from their taxable income in the first year of ownership. Not over 5 years, not spread out, year 1, gone from taxable income, completely legally. Same country, same tax code, same IRS. Two completely different financial realities. If you've seen the Instagram reels and TikToks about the G-Wagon tax hack, you've heard half the story. Today, we're going to break down the actual mechanics, the real math, the game-changing new law that just made this even more powerful, and, most importantly, the part that none of the finance influencers talk about, which is the IRS trap that can send you a massive, unexpected tax bill years after you thought you were done. To understand why this is possible, you need to understand a specific dividing line written into the U.S. tax code, and it's drawn at exactly 6,000 pounds. Under a provision called Section 280F, the IRS puts strict annual limits on how much businesses can deduct for what it calls luxury passenger vehicles. For any car, SUV, or truck with a gross vehicle weight rating, the manufacturer's certified maximum loaded weight, at or below 6,000 pounds, here's what you can deduct in year 1, $20,400. That's it. Even if you bought a $100,000 Tesla Model S, even if you used it exclusively for business every single day, the cap is $20,400 in year 1, then $19,800 in year 2, then $11,900 in year 3. You'd be depreciating that $100,000 car for the better part of a decade. Now here's the dividing line. Under Section 179 of the tax code, vehicles over 6,000 pounds GVWR are classified differently. They are not subject to those same Section 280F luxury auto caps. This provision was originally designed for pickup trucks hauling equipment, cargo vans making deliveries, and heavy-duty commercial vehicles, legitimate business tools that happen to be large. The logic was, these aren't luxury toys, they're work equipment. But then luxury automakers figured out how to build vehicles that clear 6,000 pounds GVWR while looking spectacular in a school parking lot. And the tax code didn't anticipate that. Here are some vehicles that currently clear that threshold, verified from their manufacturer GVWR labels. The BMW X5 at certain trims starts at 6,063 pounds. The BMW X7 runs 6,493 to 6,768 pounds. The Mercedes-Benz GLS 6,724 to 6,945 pounds. The Cadillac Escalade 7,400 to 7,600 pounds. The Lincoln Navigator 7,300 to 7,600 pounds. The Mercedes G-Class, which you've seen all over social media, right around 6,900 plus pounds depending on trim. The Chevy Suburban, Ford Expedition, Toyota Land Cruiser, and Jeep Grand Wagoneer all easily qualify. Even the Rivian R1S typically clears 7,000 pounds, making EVs eligible too. Now, Section 179 does impose a specific cap for heavy SUVs, vehicles over 6,000 pounds that are primarily designed to carry passengers on public roads. For the 2026 tax year, that SUV cap sits at $32,000. So if you use Section 179 alone on your $120,000 Escalade, you get $32,000 in year 1. The remaining $88,000 gets depreciated over several years. But, and this is where the OBBBA changes everything. For most of the last few years, the most powerful tax tool for business vehicles, called bonus depreciation, was getting less powerful every year. Under the Tax Cuts and Jobs Act of 2017, bonus depreciation was 100%. By 2023, it had dropped to 80%. By 2024, 60%. It was scheduled to fall to 40% in 2025, 20% in 2026, and be completely eliminated by 2027. For the heavy SUV strategy specifically, this mattered a lot. Under Section 179, heavy SUVs are capped at $32,000. The additional deduction on the remaining cost came from bonus depreciation. When bonus depreciation was only 40%, that left a large chunk of the vehicle cost to be depreciated slowly over time. On July 4, 2025, the One Big Beautiful Bill Act was signed into law. Among many other provisions, the OBBBA did something enormous. It permanently restored 100% bonus depreciation for qualifying property acquired and placed in service after January 19, 2025. Not temporarily, permanently. The IRS confirmed this in Notice 2026-11 issued in January of this year. Here's what that means for the heavy SUV strategy in practical terms. Let's take a real example. You buy a 2026 Cadillac Escalade, GVWR 7,400 pounds for $90,000. You use it exclusively for business. Step 1. You apply Section 179, which is capped at $32,000 for heavy SUVs. That's $32,000 off your taxable income. Step 2. You have $58,000 of remaining cost basis, the $90,000 purchase price minus the $32,000 you just expensed through Section 179. Step 3. Under the OBBBA's 100% bonus depreciation, you can deduct that entire remaining $58,000 in year 1. No cap on the bonus depreciation piece for heavy SUVs. Total year 1 deduction, $90,000. You deducted the entire vehicle in the year you bought it. The OBBBA also raised the overall Section 179 deduction limit from $1 million to $2.5 million. Now, $2.56 million with inflation adjustments for 2026, with a phase-out starting at $4.09 million. This means businesses with significant capital expenditures, not just individuals buying one luxury vehicle, can deploy this aggressively across their asset base. For context, under the old 2024 rules, that same $90,000 Escalade purchase would have yielded a year 1 deduction of about $66,500, $30,500 in Section 179, plus 60% of the remaining $59,500. The OBBBA difference in this single vehicle purchase, $23,500 additional deduction pulled into year 1. For a business in the 37% bracket, that's $8,695 in additional tax savings just from this one law change. This is why, right now in 2026, this strategy is genuinely more powerful than it has been in several years. The OBBBA didn't create it, but it significantly amplified it. Now we get to the part that social media absolutely butchers. Because if you've spent any time on financial TikTok or YouTube Shorts, you've seen the version of this story that goes, buy a G-Wagon, deduct the whole thing, and the government basically pays for your car. The videos make it sound like the tax code is literally writing you a check. Here is the most important concept in this entire video, and I need you to say it along with, a deduction is not a credit. A tax credit reduces your tax bill dollar for dollar. If you get a $55,000 tax credit, the government literally owes you $55,000 less. A tax deduction reduces your taxable income. If you get a $55,000 deduction, it reduces what you pay tax on, which means your savings depend entirely on your marginal tax rate. Let's do the real math on a Mercedes G-Wagon. Current base price, roughly $140,000 for the standard G550. Let's round to $150,000 as a working number. GVWR, approximately 6,900 pounds, qualifies as a heavy SUV. With 100% business use and the OBBBA in place, a business owner can deduct the full $150,000 in year 1, $32,000 via Section 179, and $118,000 via 100% bonus depreciation. If that business owner is in the top federal income tax bracket, 37%, their tax savings on a $150,000 deduction is $55,500. So they pay $94,500 for a car that cost $150,000. That's not nothing. $55,500 in real tax savings is genuinely significant money, but it is not a free car. It is a car that the government helped you afford by $55,500. If the same buyer is in the 32% bracket, their savings are $48,000, meaning $102,000 out of pocket. At 24%, $36,000 saving, $114,000 out of pocket. And if you're a W-2 employee, if your income comes from a regular paycheck and not a business, this entire strategy is unavailable to you. Section 179 applies to self-employed individuals and businesses, not employees. Now add the costs the influencers never mention. A Mercedes G-Wagon runs anywhere from $5,000 to $8,000 per year in insurance. Annual maintenance on German luxury vehicles has a well-earned reputation. An oil change runs $300 to $500. A tire set will cost $1,500 to $3,000. Any major mechanical issue is expensive. And here's an accounting detail that often surprises people. Once you take Section 179 or bonus depreciation on a vehicle, you cannot use the standard IRS mileage rate to deduct driving expenses going forward. You're committed to tracking actual expenses, fuel, repairs, insurance, registration, for the life of the vehicle. The record-keeping burden is real, and there are two more rules that determine whether you qualify in the first place. The 50% rule. To claim Section 179 or bonus depreciation on any vehicle, you must use it more than 50% of the time for genuine business purposes, not 49%, more than 50%. And that 50% must be documented with what the IRS calls contemporaneous mileage log, kept in real time, not reconstructed from memory in April. The date, the destination, the business purpose, and the beginning and ending odometer reading for every single business trip. Get this wrong or fail to prove it in an audit and the deduction vanishes. And worse than that brings us to the final section. Here's the part of this story that every 60-second social media finance video completely omits, either because the creator doesn't know it or because it kills the clickbait angle. To qualify for Section 179 and bonus depreciation on a vehicle, you must maintain more than 50% business use, not just in the year you buy it, but throughout the vehicle's entire 5-year IRS recovery period. Every year for 5 years, the IRS can ask, is this vehicle still more than 50% for business? If the answer in any of those years is no, the recapture rules kick. Here's what recapture means. The IRS recalculates your depreciation as if you had used a slower, regular depreciation schedule all along. The difference between the accelerated deduction you already took and what the standard schedule would have allowed is treated as ordinary income in the year your business use dropped, not capital gains, ordinary income taxed at your highest marginal rate. Let me make this concrete. You bought a $120,000 Escalade in 2025. You deducted the full $120,000 in year 1. Year 2, your business changes. Maybe you take a W-2 job that comes with a company car. Maybe your client base shifts and you're working from home more. Your Escalade, which used to log business miles all day, now sits in your driveway most of the week. Personal use climbs to 60%. Business use falls to 40%. Recapture is triggered. The IRS takes the $120,000 you deducted and compares it to what regular 5-year MACR's depreciation would have given you over those 2 years, something like $20,000 to $25,000. The difference, roughly $95,000 to $100,000, gets added back to your taxable income in the year your use dropped. If you're still in the 37% bracket, that's a surprise tax bill of $35,000 to $37,000 on a car whose current market value might only be $80,000 or less. This is reported on IRS Form 4797. It arrives as a line on your Schedule 1 of Form 1040 and hits your taxable income just like a salary payment would. The car is still sitting in your garage. You haven't sold it. You don't have the cash from a sale to pay the bill. You just have a tax liability that materialized from a change in how much you drive the car for work. Common recapture triggers that people don't anticipate. Starting a new job that provides a company car. Relocating and now having a personal commute that outpaces business use. Your business slowing down. Giving the car to a family member. The IRS auditing 3 years later and finding your mileage mileage logs don't support the business use percentage you claimed. And importantly, many states don't conform to federal bonus depreciation rules. California, for example, historically has not. Even if your federal return reflects a $120,000 first-year deduction, your California state return may still depreciate the same car over 5 years using the regular schedule, generating a meaningful state tax bill regardless of what happened at the federal level. None of this means the strategy is a scam. It means it's a real tax planning tool that comes with real compliance obligations, real record-keeping requirements, and a real penalty structure if those obligations aren't met. So who does this strategy actually make sense for? It makes legitimate, substantial sense for a business owner with genuine, documentable business vehicle use, a real estate agent driving clients to properties, a contractor moving between job sites, a sales professional covering a regional territory, someone whose business use is organically above 50% and whose mileage logs would survive an IRS audit without creative accounting. It makes sense for someone in a high marginal tax bracket, 32% or above, where the tax savings on a large first-year deduction are meaningful. If you're in a 22% bracket, you're saving $22 for every $100 of deduction. The strategy still works mathematically, but the luxury vehicle version is much harder to justify when the out-of-pocket cost remains so high. It makes sense for businesses with consistent, recurring income in subsequent years, because the recapture risk is a multi-year exposure. You need to be confident your business use will stay above 50% for the full 5-year recovery period. It does not make sense for W-2 employees. It does not make sense for people who are buying a car they couldn't otherwise afford and relying on the tax deduction to make the numbers work. If the deduction disappears through recapture, through an audit, through a change in business circumstances, the financial exposure is severe. 3 questions before this strategy applies to you. Is my business vehicle use genuinely, provably over 50% in a way that I could document if the IRS asked in 2 years? Can I afford the total out-of-pocket cost of this vehicle after the tax savings, plus insurance, plus maintenance, without the deduction being the reason the math works? Have I talked to a CPA who specializes in small business taxes, not a finance influencer who has 2 million TikTok followers? If the answer to all 3 is yes, this is a real, legal, and in 2026, a more powerful than usual tax strategy. If the answer to any of them is no, this is how people end up with a beautiful SUV in the driveway and a tax bill they didn't see coming. If this gave you information you didn't have before, hit the like button. It helps this video reach people who are about to make a very expensive mistake based on a 45-second reel. Subscribe for the next one. We're going to break down the pass-through entity deduction, which is the other strategy wealthy business owners use that nobody explains correctly.